the bar. He'll drive a funky car. Maybe we'll meet in a club and fall so deeply in love. He'll tell me I'm the one, and we'll have so much fun. I'll be the girl of his dreams. Maybe
BCA or PT Bank Central Asia Terbuka was founded by Sudirman Salim in 1957. BCA itself is arguably the biggest bank in Indonesia, with a market cap of well over 1,000 trillion in the Indonesian stock market, despite it being a private bank. And today, we're going to be uncovering its financial services in accordance with the 2022, 2023, and 2024 BCA financial reports or annual reports. Without further ado, let's get straight to it.
Net interest margin or NIM is a financial ratio used to measure a bank's ability to generate net interest income from its productive assets. NIM reflects how efficiently a bank manages the difference between interest income earned from lending activities and interest expense paid to depositors. A higher NIM indicates a greater profit margin from each unit of earning assets. The main function of NIM is to serve as a profitability indicator for the bank's intermediation activities and as a measure of the efficiency in managing earned assets. And this is the formula of NIM, or net interest margin, is net interest income divided by average earning assets times 100%. And the net interest income of BCA is taken directly from the consolidated income statement under net interest and Sharia income, while the average earning assets, to calculate the average earning assets, is the total earning assets were summed from the consolidated balance sheet for 2 years divided into 2. And from this formula, we can generate the NIM of BCA in 2022 is 5.8%. It indicates that every 100 rupiah in earning assets will generate 5.8 rupiah in net interest income. And this is also applied in 2023 and 2024. The NIM in 2023 is 6.36%, in 2024 is 6.47%. And this is the interpretation of NIM. Over the past 3 years, NIM of BCA is increased from 2022 until 2024. This increase reflects BCA's ability to manage productive assets efficiently and keep funding costs low, even amidst changes in market interest rates. Moderate NIM growth in 2024 compared to 2023 indicates a market that is starting to stabilize, while the bank continues to maintain credit quality to keep risk under control. Overall, this positive trend strengthens profitability and indicates healthy intermediation performance. ROA measures the bank's ability to generate net income from its total assets. A higher ROA indicates that the bank efficiently utilizes its assets to earn profit. The greater the ROA, the better the bank's performance in turning in asset into the net income. And the formula of ROA is net income divided by total assets times 100%. And the ROA calculation uses data from BCA's consolidated income statement for net income and from the consolidated balance sheet for total assets. And this is the ROA of BCA in 2022 is 3.1%. It indicates that every 100 rupiah of total assets will cost 3.1 rupiah in net income. And then for the 2023, it's increased by 0.35% from 2022. It indicates that every 100 rupiah in total assets will cost 3.45 rupiah in net income. And then for the 2024, the ROA is 3.78%. It indicates that 100 every 100 rupiah in total asset will cost 3.78 rupiah in net income. And this is the interpretation. Overall, the increase in BCA's ROA has shown from 3.1% in 2022 to 3.545% in 2023 and 3.78% in 2024. This increase reflects BCA's ability to optimize its asset to generate higher profit each year. This increase in ROA also shows the efficiency of productive asset management and good control of operational expenses so that the bank's profitability against total assets managed continues to improve.
NPL is a financial indicator used to evaluate the credit quality of a bank's loan portfolio, and the formula is non-performing loans divided by total loans multiplied by 100%. This ratio tells us what percentage of the bank's total loans are at risk of default. Now, we deeply talk about the formula. The numerator of non-performing loans is the loans where borrowers have failed to pay interest or principal for more than 90 days. And for the denominator or total loans is includes all credit given to customers, both performing and non-performing. And in 2022, the NPL ratio is 1.78%. That means for every 100 rupiah loaned out, 1.78 rupiah were non-performing. And in 2023, the NPL ratio increased to 1.86%. This indicates that for every 100 rupiah in loans, 1.86 rupiah were non-performing. And for 2024, the NPL ratio returned to 1.78%. Once again, for every 100 rupiah in loans, 1.78 rupiah were not performing. And for the overall interpretation, over the span of 3 years, the NPL ratio shows slight fluctuation. It rose from 1.78% in 2022 to 1.86% in 2023 and 1.78% in 2024. LDR is a financial ratio that measures how much of the bank's customer deposits are being used to fund loans. The formula is total loans divided by total deposits times 100%. The LDR indicates the bank's aggressiveness in lending relative to the available deposit funds. And now we talk deeply about the formula. The total loans is all loans given to the customers, and the total third-party funds, meaning all deposits from customers, such as savings, current accounts, and time deposits. In 2022, the LDR was 64.14%. This indicates that every 100 rupiah in deposits, the 94 rupiah were loaned out. In 2023, the LDR was 69.57%. This indicates that for every 100 rupiah in deposits, about 69 rupiah were loaned out. And in 2024, the LDR further rose into 77.51%. This indicates that every 100 rupiah in deposits, the 77 rupiah were loaned out. And for the overall interpretation, the LDR rose from 64.14% in 2022 to 77.51% 77.51% in 2024. This reflects increased confidence in lending as the bank utilized a larger portion of customer deposits to ease an interest income but also a rise in liquidity risk if not properly managed. A higher LDR means the bank has less cash buffer available, which could be risky in times of withdrawal pressure or economic stress.
So basically what it is the amount or the efficiency of one company on managing its cost in order for the company to gain its income or its revenue. Now for the equation itself is cost income equals the total expense over operating income and multiplied by 100%. Now, ladies and gentlemen, the less or the smaller the ratio indicates the more efficient the company manages its cost, thus making it even better. Now, we're gonna go straight to BCA's performance in 2022. Mind you that these calculations are in million. So now we have 36,332,646 over 83,211,282, and then we get the ratio of 43.6. So basically what it means is for every 1,000 rupiah that BCA gains or its income, BCA would produce around 436 of expense or cost. That's on the year 2022. Next is in the year 2023, we have 38,647,962 over 94,674,195, and then we get the ratio of 40.82%. Now what that means is in 2023, for every 1,000 rupiah that BCA gained as income, BCA would also produce around 408 in terms of expense or cost. That's by the year 2023. Lastly, 2024, we have 41,340,404 over 104,975,279, and then we have the ratio of 39.38%. Basically, in 2024, for every 1,000 rupiah in income, BCA would also produce around 393 rupiah in terms of cost or expense. Now, ladies and gentlemen, as you guys can see here, the amount of ratio by year to year is slowly decreasing, indicating that BCA management or cost management slowly but surely is increasing and it's getting better each year. So what it is the amount of loan used to finance an asset. So these are the equation. LAR equals to total loans over total assets and multiplied by 100%. Now, originally, the higher or the larger the LAR ratio gets, the more riskier it becomes. The company, the assets becomes more risky, and also it becomes less liquid. So now we're gonna jump into BCA's 2022 performance here. It's still in millions, the amount and the calculations. So here we have 671,977,830 over 1,291,688,026. And then we have the ratio of 52.02%. So basically what it means is for every 1,000 rupiah of assets, the amount of loan produced or generated within that asset is around 520 rupiah. That's in 2022. Next up in 2023, for the total loans, we have 730,076,671 over the total assets, which is 1,409,975,000 402,775,602, and it equals to 52.05%. That means in 2023, for every 1,000 rupiah in assets, it is produced of about 520 rupiah in loan. Lastly, in 2024, for the total loans is 790,767,149 over 1,547,456,996. And we have the ratio of 51.1%. It's a bit decreased or a bit dipped down when compared to 2022 and 2023, but nonetheless, it still shows a stable performance in terms of LAR. And in 2024, for every 1,000 rupiah of assets equals to 511 rupiah in terms of loans that BCA produced. So then again, these performance for the past 3 years indicates a stable performance in terms of loans, which indicates a very good strategic execution, and also it also indicates a balanced amount of liquid and also balanced amount of loans.
Next is BOPO or Operational Efficiency Ratio. So, BOPO shows how efficiently a bank runs its daily operations, and a lower BOPO is better because it means the bank spends less money to earn income. The formula is operating expense divided to the operating income times 100%. This means we divide the total expense by the total income from operations. In the 2022, BOPO was 34.52%. This means for every 1 rupiah of income, BCA spent 0.345 on costs. Next, on the 2023, BOPO rose slightly to the 34.92%, meaning that BCA spent about 0.349 rupiah. Next, in the 2024, BOPO dropped to the 22.29%. So, BCA only spent 0.322, so showing the better efficiency. So the interpretations, Bank BCA operational efficiency has improved significantly, as indicated by the declining in its BOPO ratio from 34.92% in the 2023 to the 32.29% in the 2024. This ratio, which compares operating expense to operating income, is a key metric in the banking performance. ROE or return on equity. So, ROE shows how well a company uses their shareholders' equity to generate or make a profit. A higher ROE means the company is better at generating the returns. The formula of ROE is net income divided to shareholder equity times 100%. This means we divide the company profit by the amount of equity invested by shareholders. Next, in the 2022, Bank BCA generated ROE was 18.83%. So, for every 1 rupiah of shareholders' money, Bank BCA made 0.188 in profit. Next, in the 2023, the ROE was 20.16%, meaning the Bank BCA made 0.206 for every 1 rupiah of equity. Next is the 2024, Bank BCA generated the 21.62%. So that means for 1 rupiah of the shareholders' equity, Bank BCA can make 0.216 rupiah annually net income. So, the conclusions to Bank BCA profitability has also continued to strengthen because we can look at the rise of its ROE from the 80.82% in 2022 and to the 21.62% in 2024. This increase indicates that Bank BCA is utilizing the shareholders' equity more effectively to generate net income.
A financial ratio used to measure the bank's ability to absorb the potential losses and to secure depositors by ensuring that the bank has sufficient capital to cover its risk-weighted asset. It can be calculated by dividing the bank's capital with its risk-weighted asset. The bank capital itself is the total of the financial buffers to absorb losses and to support operating activities. And the bank capitals, this formed by two types of capitals. The first type is the Tier 1 and the second type is the Tier 2. The Tier 1 is the core or the main capitals that consists of the capitals that have a strong or have the most reliable sources. The example is the retained earnings. And for the second type of the capitals or Tier 2 is a supplementary capitals. As its name is supplementary, it means to support the main or the core capitals or the Tier 1 capital. So the next is the risk-weighted asset. Is the total asset of the banks that's already calculated with its calculated risk. It's usually already shown and already calculated by the banks and it's showing up in their annual reports. Okay, let's move into the analysis of the CIR ratio of Bank BCA. In the 2022, by calculating the bank capitals, before I start to calculate and we start to analyze, all of this number here is calculated in billion. So in here, in 2022, we got the CRA ratio is 0.268 and so on. Or we can also say it is 26%. Or it means, if we interpret what is the meaning of these numbers, that means that in every 100% of risk-weighted asset, the banks hold on 26% of their capitals. And it's also going the same for the 2023. It has 29%, and in 2024, it has 29% also. So, if we interpret all of the year here, it's actually the bank BCA, it already have a good CIA ratio by the rules, by the rules that OJK already implemented in the rules in number times in the year of 20 and 8. It says that the bank has to have a minimum 8% of CRA ratio. Is it a ratio to evaluate how resilient the company into the debt? And we can calculate it by dividing the total liabilities with the shareholders' equity. Okay, let's just move into the analysis because I think I don't have to explain more about the liabilities and equity. I understand and all of the viewers here already understand and already know about liabilities and equity. So, in 20 and 22 for the annual report that we've got from the BCA, they had I want to confirm again that all of the number here is same just as previous is counted in billion. So in 20 and 22 they got the total liabilities approximately 1 million and so on in billion. Is a really high number. I don't know how I say it in this high number. And in this 2022 they got a shareholder equity approximately to 200 million and so on. And from this amounts, the DIR and 2022 from the PT BCA, they got 5.0 and 4, which means that in every 1 rupiah in shareholder equity, the banks rely on 5 rupiah in the debt or in the liabilities. It means that is this company, this bank have a high financial risk that they really dependent on the debt. Is implying the same. The interpretation is the same for the 2023. They got 4.88, and for the 2024 they got 4.55. But as we can see here, that the result or the ratio of the DIR here is tend to be reduced. It tends to be decreases by year to years, which means that this company, these banks, is even though they have a high ratio and high depending on the debt, they actually already manage the DIR really good. As you see here, the ratio is have a reduction trends. And as we know, the DIR, the less the DIRs, it means that the better the company.